It's 11:47 p.m. You're doom scrolling through Zillow with the same energy a gambler brings to a slot machine. 3 bedrooms, updated kitchen, charming starter home, only $425,000. And somewhere in the back of your mind, your coworker's voice echoes, "Rent is just throwing money away, man. We've got so much equity in the house now." They say this while adjusting their Ring doorbell and pretending their adjustable rate mortgage isn't a ticking time bomb. But here's the thing nobody told you, and what your coworker definitely won't mention between humble brags about their granite countertops. That down payment you've been scraping together, that's not the finish line, that's the starting pistol. Because somewhere between pre-approved and congratulations homeowner, there's a document called a closing disclosure, and inside that document is a number, usually between $8,000 and $25,000, that the entire real estate industrial complex conveniently forgot to mention while you were emotionally investing in that walk-in closet. I'm not here to tell you home ownership is bad. I'm here to tell you that the game is designed for you to learn the rules after you've already bet your financial future. Let's talk about closing costs, the poverty tax called PMI, and why walking away from a deal that would make you house poor isn't failure. It's the most financially sophisticated move you can make. Let's establish baseline reality. As of January 2026, the median home price in the United States is approximately $410,000. But here's where it gets fun. In many markets, California, the Northeast, major metros, a starter home now crosses the $500,000 threshold. In 233 US cities, a starter home costs $1 million or more. More than half of those are in California. In Malibu, a starter home averages $4.8 million. That's not a home. That's generational debt wearing a fresh coat of paint. But let's be generous. Let's say you found something reasonable, a $500,000 house in a market where that still gets you actual walls and a roof. You've been disciplined. You saved. You scraped together a 5% down payment, $25,000. That's real money. That's sacrifice. Here's what happens next. The poverty tax, PMI. Because you put down less than 20%, you now pay private mortgage insurance. PMI protects the lender, not you, if you default. You're paying for insurance that benefits someone else. Current PMI rates range from 0.46% to 1.5% of your loan amount annually. On a $475,000 loan, that's anywhere from $2,185 to $7,125 per year. At the higher end, you're paying an extra $594 per month, just for the privilege of not being wealthy enough to put 20% down. That's the first punch. Property taxes. Depending on your state, property taxes can range from 0.3% to over 2% of your home's assessed value annually. In states like New Jersey, Texas, and Illinois, you're looking at $8,000 to $12,000 a year in property taxes alone. That's $667 to $1,000 per month. That doesn't touch your principal. Homeowners insurance, premiums have skyrocketed. National averages now hover around $1,700 to $2,500 per year. But in disaster-prone states, Florida, California, Louisiana, you might be paying $4,000 to $8,000 annually. Some areas are becoming effectively uninsurable. Add it up. Before a single dollar goes toward actually owning your home, you could be paying $1,500 to $2,000 per month in what I call ownership theater, money that disappears into the void while you pretend you're building equity. Now let's talk about the moment no one prepares you for. You've survived the bidding war. You've endured the inspection anxiety. Your offer was accepted. The mortgage is locked. Then, 3 days before closing, a document arrives, the closing disclosure. And there, buried in fine print, is a section called Closing Costs. Current national data shows closing costs typically range from 2% to 5% of the home's purchase price. On a $500,000 home, that's $10,000 to $25,000. Due at closing, in addition to your down payment. Let me repeat that. You need $25,000 for your down payment and up to $25,000 more for closing costs. That's $50,000 in cash to close on a starter home. What's in closing costs? Let me walk you through the ambush. Loan origination fees, 0.5% to 1% of the loan. That's $2,375 to $4,750. Appraisal fees, $300 to $600. Title search and title insurance, $300 to $2,500 plus. Escrow fees, $350 to $1,000 plus. Recording fees, $20 to $250. Prepaid property taxes, often 2 to 6 months up front. Prepaid homeowners insurance, usually a full year up front. Prepaid interest covers the gap between closing and your first payment. Attorney fees, required in some states, varies widely. Home inspection, $300 to $500. And if you're buying an FHA loan, add an upfront mortgage insurance premium of 1.75% of the loan, another $8,312 due at closing. Some markets are worse. Washington, D.C. buyers paid an average of $17,545 in closing costs in 2025. New York and Delaware averaged over $12,000 and $13,000 respectively. This is the moment the real estate industrial complex hopes you're too emotionally invested to walk away. You've already told your friends, you've already measured for furniture, you've already imagined Thanksgiving in that dining room. And now they hand you a bill for $23,000 and watch you scramble. Here's why this keeps working on smart people. It's called social comparison theory. You're not just buying a house, you're buying relief from the shame of renting. Every time someone asks, do you rent or own? There's a value judgment embedded in that question. Owning equals success. Renting equals failure. Owning means you've made it. Renting means you're still figuring it out. This is, of course, complete nonsense. Here's the truth nobody at the barbecue wants to admit. A 30-year mortgage is a rental agreement with extra steps. When you take out a mortgage, you're not buying a house from the bank. You're renting money from the bank. And for the first decade of most 30-year mortgages, the majority of your payment goes toward interest, not principal. On a $475,000 loan at 6.5%, your monthly payment is roughly $3,000. In year one, approximately $2,570 of that every single month goes to the bank as interest. Only $430 actually reduces what you owe. You're not building equity. You're renting your lifestyle from a financial institution while also being responsible for every broken water heater, every roof leak, every foundation crack, and every property tax increase. Meanwhile, the guy bragging about his equity at the office party, he drives a luxury SUV he can barely afford, has a Ring doorbell on a house he's leveraged to the hilt, and is one unexpected medical bill away from financial quicksand. Performing wealth is not the same as building wealth. So what's the alternative? Walking away. Not forever, not necessarily, but walking away from a deal that would make you house poor is not a failure. It's a strategic refusal to participate in a game where the rules are hidden until you've already committed. Here's the $20,000 rule I want you to remember. Having $20,000 in liquid, accessible savings is what I call the cognitive freedom threshold. Below that number, every financial decision is made from a place of scarcity and panic. A broken transmission, a surprise medical expense, a job loss. Below $20,000, these aren't inconveniences. They're existential threats. Above $20,000, you have breathing room. You have options. You have the ability to think clearly instead of reacting desperately. If buying a house wipes out your savings and leaves you with $3,000 in the bank and a prayer that nothing goes wrong, you haven't bought freedom. You've bought a prison with granite countertops. The decision to say not yet or not this one isn't weakness. It's the recognition that financial security isn't about the assets you accumulate. It's about the options you preserve. Let's talk opportunity cost. Say you don't buy that $500,000 house. Instead, you continue renting for $2,000 a month while the would-be homeowner pays $4,500 monthly. Mortgage, taxes, insurance, PMI, maintenance. That's $2,500 per month in difference. $30,000 per year. If you invest that difference in a diversified index fund, returning a historical average of 7 to 10% annually, here's what happens. After 10 years, $435,000 to $520,000. After 20 years, $1.23 million to $1.73 million. After 30 years, $2.84 million to $4.96 million. The homeowner, meanwhile, is fossilizing their money in drywall and wood. Their $500,000 house might appreciate to $800,000 over 30 years if they're lucky and maintain it properly. But they've also paid over $600,000 in interest, $180,000 plus in property taxes, and God knows how much in repairs, insurance, and HOA fees. The house isn't an investment. It's a place to live that sometimes appreciates. Real wealth isn't built by locking your capital into an illiquid asset that costs you money every single month. Real wealth is built by maintaining liquidity, investing consistently, and refusing to let society's homeownership mythology dictate your financial timeline. Here's what I want you to do. Stop looking at what you qualify for and start looking at what you can actually afford. Qualification is a bank's assessment of the maximum debt you can service without immediately defaulting. It has nothing to do with financial health, flexibility, or freedom. Affordability means after the mortgage, after the taxes, after the insurance, after the maintenance fund, after the closing costs, you still have money to invest, to save, to live, and to breathe. If buying a house means you can't max out your 401k, can't maintain a 6-month emergency fund, and can't sleep at night without worrying about a single unexpected expense, you're not ready. And that's not failure, that's wisdom. The real estate industry wants you emotional. They want you comparing yourself to your coworkers. They want you to feel like a failure for renting. Don't give them that power. Build your cash reserves, invest the difference, wait until buying a house is a choice, not a desperate grasp at societal approval. Because the goal isn't to own a home. The goal is to own your future. And that future doesn't start with a $25,000 surprise and a prayer. If this made you think twice about that midnight Zillow session, hit subscribe. I drop videos every week breaking down the financial traps nobody else wants to talk about. And if you're already in a situation where closing costs caught you off guard, drop a comment below. Let's talk about it. You're not alone, and there might be options you haven't considered. Stay liquid, stay skeptical, and never let anyone shame you for making the financially smart choice.